everyone. Welcome back. Moderating our next panel, CLO Mezz, is Anthony Scheck and Nader. Anthony serves as Copentech's head of business development and works side by side with investors and managers as they use Copentech's platform to simplify structured products. Prior to his work in fintech, Anthony had senior roles at Guggenheim Partners, Wells Fargo, Morgan Stanley, Goldman Sachs. Anthony earned an MBA from the UCLA Anderson School of Management and a mechanical engineering degree from UCLA, where he also was a 4-year letterman in football. So very impressive. I'm going to hand it over to you now, Anthony.
Thank you very much, Jocelyn. I appreciate your time and welcome everybody who's joining us in the panel. I see we have all the panelists, so welcome. Let's just start. I'm going to ask the panelists to introduce themselves and just state the fund's focus that they work in and your responsibilities. Shiloh, can we start with you?
Yeah, sure. Hi, everybody. My name is Shiloh Bates. I'm the CIO of the Flat Rock Opportunity Fund. We invest in both CLO equity and mezzanine tranches in broadly syndicated and middle market deals.
Great. Steve?
Sure. Hi, everyone. I'm Steve Page. I'm from Barings Asset Management. I'm a trader for CLO paper. We invest in AAA through equity and primarily broadly syndicated CLOs.
Great. Thank you. Andy?
Hi, I'm Andy Ross from Pacific Asset Management. We are a wholly owned subsidiary of Pacific Life. We have in excess of $14 billion of assets across bank loans, structured credit, high yield, and investment grade. I'm a member of the CLO tranche investing team, where we have approximately $750 million of assets under management, from double Bs all the way up to AAAs. And I'm also a structurer on our Trustal CLO platform, where we've issued 3 CLOs.
Thank you. Olivier?
Hello, everyone. My name is Olivier Gozlan. I am a portfolio manager at Crystal Fund, and I've been trading CLO equity, single B, double B, and some triple B tranche since 2006 on behalf of various vehicles that we manage.
Thank you. And then finally, Arun.
Thanks. I'm Arun Sharma. I'm partly with MasterCard, but my CLO engagement is with AXA Investment Management, as well as a couple of other clients, including the IFC, the International Finance Corporation. I previously was the Chief Investment Officer at IFC and also a global head of structured finance focused on CLOs in emerging markets. But with my current role, I'm more focused on advising AXA, particularly in unfunded participations in CLOs, typically at the Mezz level.
Thank you. Okay, so let's start. First off, we're going to start with a recap. What I want to do, and I'll share my screen real quick. Full screen. Bear with me 1 second. So I'll share my screen, and we put together just a quick recap of the CCC bucket exposure for the year. Can you see that? So basically, the first topic, we're just going to look at the market volatility as represented in the CCC percentage. This graph through January through November. As you can see, January, February, March were pretty tame. We hovered around 3.5% as a median for CCC exposures and CLOs. Obviously, what happened in the middle of March resulted in a wide spike in CCC exposures, which by the end of May was around 11%. So about a 3 times spike in normal activity in terms of CCC buckets. And now in November, it's around around 8%. If you look at double B spreads during that time as well, before the pandemic, it was around 675, high 600s, spiking to over 1,300 plus, and now I would say between 850 to 950 in terms of spreads. I wanted to start with Olivier. If you could start off the conversation, obviously this was a big upset in the market, and just how did you manage this as a CLO Mezz investor? And were there any themes that you observed looking back over the year?
Yeah, sure. Thank you very much, Anthony. Before we dive into the few takeout from your very interesting slides, I don't want to repeat what many people may have seen and heard, but in terms of what we've seen this year with this pandemic, we've seen a price movement with a velocity that we have not seen before. If we look at the corporate loan price index or the CLO tranche price index, the movement that we've seen on both sides of the V curve, if I may say, what took this year 3 weeks, less than 1 month, to move from pre-COVID level to the bottom of COVID-19 level, took 3 weeks, less than 1 month. The same type of movement were seen in 2016. I will call that during the oil and gas crisis, in about 10 months, close to 1 year. And in the great financial crisis in 2008, it took about 18 months. So in terms of velocity, I'm sure everybody has seen it, but I want to emphasize the fact that it's a huge, velocity that we've seen compared to anything else that we've seen in the past cycle. Coming back to your chart and more connected to our CLO mezzanine discussion, I think you brought up a very interesting chart about triple C bucket. So what we are seeing now is that obviously triple C has increased, and even now triple C is still above the 7.5% threshold, which is let's call it the tolerance threshold in the CLOs, because above that you have much bigger haircut and a much higher risk of cash diversion. So we are in this situation where clearly the risk has increased, as illustrated by triple C, the triple C bucket, and we could look at other fundamental metrics, but the triple C bucket is a very good metrics. And yet, if you look at the DM of double B, triple B, we are almost not yet there, but we are almost at pre-COVID level, which might seem a little bit counterintuitive when you think about it, because we are in a more risky environment, and yet the level, there has moved a lot, but we've almost got back to pre-COVID level, and I think there are probably two clear reasons for that. The first reason is the fact that CLO mezzanine are resilient. I believe CLO player, and you've got few of them on this panel. CLO mezzanine player understand that the resistance level to mezzanine is not linear. You have a certain threshold, a certain level of default that you can resist, and this might be quite supportive from a trading point of view. We've seen. I recall back in July this year, there was in my portfolio, I was seeing about 20% of my I'm trading mainly distress single B and double B. So I would say probably 20% of my portfolio had OC test failing, junior OC test failing in July. And by the October payment date, only a little bit below 10% had OCs failing actually. So the protective mechanism of the OC test seems to function. We still need to see the end of the full end of the crisis, but the CLO mechanism is functioning, and we've seen fundamentals of the CLO mezzanine, basically resisting the distress environment. The second reason, on top of the resilience of the CLO mezzanine, is probably more, I would say, more technical. There was, clearly a lot of, additional liquidity in the market. That's the least we can say, coming from central banks and from the governments. So this has, pushed the price up. And there was also probably some, opportunity consideration where you see all the asset class increasing. You may have some demand that increase in the CLO market, and that has pushed price a little bit upwards. And I think that's probably something that I find relatively new within the CLO Mezz. CLO Mezz, I was tempted to see them as a little bit separate to other asset class, a very fundamental focus, fundamentally oriented with a sort of niche market player. And what we've seen, they followed actually the price movement of other asset class. So that's coming from what I would call more technical consideration and opportunity trade for market player.
Yeah. So essentially the technicals basically have somewhat overwhelmed the fundamental approach that you normally take in the CLO Mezz market, and also the speed of the decline has accelerated, maybe also the speed of the recovery as well. And as you mentioned, the resiliency of the CLO structure has really come to bear.
Yes.
I guess are there any other questions or comments from the panel that they would like to add?
Maybe I should just add one more slight comment, and I'm sorry I don't want to keep talking, but something also worth mentioning is the volume of trade, which go in the same trend that what we are discussing. The technicals. I mean, the volume. The pre-COVID. Usually, when I log in the morning and I see the bi-weeklies, there is pre-COVID there was, I would say, 40 to 50 bonds on bi-week, sometimes 70. That was before COVID. This year, I would say on average, there was around 80 line item on B-week, and we had few days with above 100 line item on B-week. So the volume also sort of supports the idea.
The secondary volumes have spiked. We've definitely seen that in our own analysis that we've done at Copentech. I want to open up the discussion to the panel and just talk about the current conditions as well as opportunities. I'm going to share my screen one more time to go to the next slide. Which is in December, we at Copentech did a study on secondary CLO spreads just for single Bs, double Bs, and triple Bs. And this is what we've come up with. Essentially, single Bs are around 1150 or 12, close to 1200 in terms of DMs, in terms of secondary trades. Double Bs around 800 to 900, a little over almost 1,000. And then the dispersion for triple Bs is very, very small compared to the other two, coming close to around 40 or 400 in terms of DM spread. The first question I have is for Steve. Given kind of where we are right now, where do you see the recovery status? Do you think it's over? Are we in line for more tightening or widening? What's your thoughts?
Sure. So I agree with what Olivia said as well. The dislocation was very quick, and the subsequent recovery has been very quick as well. So, we fell pretty hard. We have recouped a lot of that widening as of today. We have not recouped all of it. And so if I look back at our double B portfolio and just kind of where it's marked today versus where it was marked pre-pandemic, back in mid-February, our double B book was marked at about 97, and today it's marked at 95. So, we have recouped a lot of the loss, but we still have, some tightening to go, I think. So it's very vintage specific as well. If you look at 2018 vintage double Bs, they're still marked in the low 90s. They typically have the lowest spreads, and so they offer the most discount. You know, we're fairly bullish on the background for 2021. I think if you look at things like the vaccine rollout, I'm sure there'll be some hiccups around that, but just in terms of general macro, it seems like we're going to be in a steadier position in 2021 than certainly we have been in 2020. And then if you consider some of the technical factors in the CLO market as well, I think resets could come back in a pretty big way in 2021. And to that extent, you may get some pull to par on discounted double Bs that are in CLO structures that are going to be reset. And you also just have a lot of general Mezz demand. There were a lot of opportunistic funds raised throughout 2021 or 2020 during the dislocation. Citi had a call yesterday where they estimated that it's, you know, at least 25 funds were raised for something like 5 to 10 billion of CLO Mezz capacity. So all of that capital certainly has not been put to work at this point. And, you know, there are different estimates out there on how much there is still left to put to work. But I think, you know, regardless of what the number is, I think the signal is clear that there's going to be continued technical demand for CLO tranches. So I think if you add all that up, and the fact that, you know, we have a double B book that's still marked at 95 and a couple of points below where it was back in February, it's easy to see a scenario where you get 2, 3, 4 points of principal return in 2021, and you put that on top of a 6 or 7% carry that you're getting, and you're up to a 10% total return for double Bs, which I think is going to be pretty attractive to investors in a yield-starved investment universe like we're in. So for that reason, we're fairly bullish. I think if you look at where new issues are, double Bs are mostly coming at par now and mostly kind of in the high 600s. So in terms of spread compression and new issue, I think it'll be fairly moderate from here, just because we have run quite a bit and there's not a lot more to gain in terms of price appreciation. But in the secondary, I think there's still some decent opportunity.
Hey, just a quick follow-up to you, Steve. What tenor deals do you prefer? Do you prefer the shorter or longer? Obviously, the 3-1 kind of structure was very popular during the disruption. Do you see that continuing, and what do you prefer?
Sure, I'll try to be quick on this. I don't want to take too much of the time. I would say, you know, tenor isn't really driving our investment decision making at this point. It is a factor. You know, I think because we're generally positive for 2021, taking advantage of that by buying you know, like 2018 vintage deals that are going to be a little shorter tenure, I guess, relative to like a 2019 or on the run new issue makes sense because you can capture some of the discount. But I also like the idea of barbelling that with some recently issued or new issue double Bs on a go forward basis, because I do think we'll continue to have some hiccups as, you know, we digest headlines around the rollout of the vaccine and the uptake and the efficacy of it. So I think if you barbell between the two, you'll be in a pretty good position to outperform with your bucket that's focused on more new issue or more like 2020s that could lengthen out and you'd have better carry and will certainly outperform in a more bearish scenario. But if we do get kind of a quicker uptake on the vaccine and a more bullish outlook, then I think you'll benefit from those more convex profiles, the 2018 vintages of the world.
Sure. Hey, Andy, I'd like to get you involved. Where do you see opportunities, the current opportunities in CLO Mezz, and what are your thoughts?
Well, I could piggyback on that question you just asked, and I think I think it was answered pretty well. For new, the thing that's been happening in the past couple of months with new issue, with deals going to 3-1 structures, is that you're getting your carry locked in for perhaps a lot shorter than you're used to. So particularly the past couple of months when new issue double Bs were coming in the mid to high 7s, if not the 8s, it was actually more attractive to see a 5-2 structure where you could lock that in for a lot longer. The risk of these coming in a 3-1 or that you're going to get called out within a year or a year and a half, which is actually the play of the equity, which is one reason why equity likes a shorter deal so they can turn that around quickly. Mm-hmm. For more seasoned deals, certainly being closer to call or past the call is ideal because you can get that realization to par much faster, although you can also get it just from the market generally rallying. One of the things we talked about in preparation of this call is where we see other markets and credit at today.
Yeah.
Certainly you see double B loans coming out anywhere from plus 250 on double Bs, maybe a little bit wider, single Bs, more 350 to 400. That's in primary. Secondary tends to trade a lot tighter than that. That's in loan land. In high yield, you're seeing double Bs currently at 337, the overall index at 4.4. And then if you go up to IG, you see yields of 1.2. So it's been mentioned already that this global chase for yield, with yields really coming back down so low, ag investors, IG investors start looking to high yield investors start looking at different types of structures like alt products, which frankly CLOs are, that generate that extra pickup in yield. So generally, we have always seen CLOs trade and yield more than comparable corporate credits. And that's a pickup that we believe is due to it being a nichier asset class, although certainly at over $600 to $700 billion now, niche isn't probably the right way to describe it. Maybe nuanced in that corporate guys think of it as structured, so they might shy away. Structured guys get uncomfortable with the reinvestment aspect and the active portfolio management. So that's why it takes a different lens to view it. And that's why I think the spreads typically are wider in general. And so even if we do get to that normalization where we get that final last couple points of appreciation on double B books, we should continue to see a wider spread in CLOs. And the question will be, how does that come in even more? We've seen double Bs start to trade in the low sixes. We've seen some static deals, double Bs trade in the fives on DM. Will we get all the way back down to the fives where we were a couple of years ago? We'll have to see how that goes. But given where the markets are, and then there's a lot of yield hungry investors out there. There are pension plans that have higher target returns they need to hit. It's possible. I don't know how long it's going to take. I think it is the reason that we've seen the markets go on fire since the election. You'd be hard pressed to find a market that's rallied harder since the election than double B CLOs. The indices up 7 to 8% on double Bs since that point, and frankly, it was the last game in town in terms of getting the yield, and that had yet to get back to pre-COVID levels. And as mentioned, it's still got a little way to go, but given where we were in March and April, it seems like we're more or less there.
Yeah.
So the outlook from the technical standpoint certainly looks very bullish. From the fundamental standpoint, we've seen a lot of positive news on the vaccine. It does seem like we're going to move past COVID. Unfortunately, we had some destruction in terms of things like what's happened in the retail sector, and energy is always going to be problematic. But the CLO structures are generally performing as we expect. So I think fundamentals and technicals are both pointing to a fairly bullish scenario going forward. Although when you talk about a couple points of appreciation, again, compared to 5 or 6 just in the last 6 weeks, it doesn't seem like that much, but in general, that makes for a very solid annualized return.
Yeah, and we'll touch on a little bit of forecast a little bit later, but I still want to focus on kind of the current opportunities in Shiloh. I'm hoping that you can shed some light on how you evaluate double Bs versus equity. Which one is more attractive in your in your opinion?
Sure. So historically, I'm really a buyer of equity. I've been doing that since 2012. But throughout this year, fortunately, our fund has been able to raise money, and I think the opportunity set, especially like in April and May, really and really, kind of continuing through the summer, really favored Mezz. And so, how we looked at it was that, say, if you're like modeling a deal in May or June, and you're looking at buying a pretty dinged up double B, maybe with like a $70 price or something like that. If you try to figure out what's the constant default rate, kind of through to maturity that will like break this position, we're seeing stuff that's like, 5% and higher, 5 to kind of like 10 to 12 area. And the returns offered are, mid to high teens.
Yeah.
And if you compare that, and if you kind of like rewind the clock to pre-COVID and you're buying equity, well, you're hoping for like maybe 13 to 15% returns, and you need a 2% default rate for that to work out. So, we felt like that was a real no-brainer. So we came into the COVID period with, almost exclusively in equity. Today we're like 45% into this double B trade. And as the year has progressed, one thing that's interesting is the market's rallied for double Bs quite a bit, but it doesn't necessarily mean that the opportunity set is, the opportunity for returns is lower. So for example, as the deals recover, you're definitely going to pay a higher dollar price for your double B. But at the same time, the prospects that you get called out sooner are actually like much higher. So you can still, in my opinion, pay into the 80s for some of these double Bs. And if you think you can get out, in a call situation in like 2 years or something like that, obviously the returns are going to be pretty favorable. And, the kind of double Bs that I liked are like very dinged up double Bs where, maybe they're failing an interest aversion test or an OC test. I think it's a great strategy to buy double Bs that aren't paying the equity. And if you can just sit there for like a number of quarters and watch your MVOC naturally improve as the deal delevers or potentially buys like more collateral, I'm all for that. In the current environment, though, I mean, I definitely do see some very interesting opportunities in equity. So in primary, for example, you get loan portfolios that are pre-sorted to kind of avoid the COVID impacted loans. You're benefiting from LIBOR floors, and the liability pricing is like coming in a fair amount, and you can build these portfolios of loans at like nice discounts to par. So all of that, actually, the economics of like new primary also I think is like pretty favorable right now.
Yeah. I want to switch gears a little bit, and Andy, I'm going to ask you to comment first, and anybody else who wants to. But the idea of manager dispersion that's been increased so much in the market, do you think it's warranted? And is it more pronounced in triple Bs or double Bs, or what are your thoughts?
I think it's absolutely warranted. It may have been a long time coming. One could argue perhaps there should have been more tiering pre-COVID, but certainly it's here now. To answer the second question directly, you do see more tiering lower in the capital stack, so more in double Bs than you do in triple Bs than you do in single As, and so on and so forth. And that's just due to the increased likelihood of the lower part of the capital stack becoming a fulcrum type security or having default activity.
Yeah.
So it stands to reason that that the lower parts of the cap stack will continue to have that. And you see that in the spreads that are posted out in the market. Double Bs are quoted anywhere between 625 and 1025.
Right.
And in June, it was more like 750 to 1350. So things have tightened a little bit as we've gotten a better understanding. I think pre-COVID, the spread was probably 150 to 200 across all double Bs. And what's driven that is more or less the market values of the portfolios and the outlooks for particular deals. I think another thing that needs to be watched going forward is the outlooks for the organizations themselves. We spend a lot of time trying to understand the CLO managers and their place in the organization and their incentives and their ownership structure and how much control they have over the future, whether they have other lines of business, et cetera, and what their outlook is.
Yeah.
To the extent that there are managers that are going to have difficult times doing new deals because of performance issues or because they don't have equity lined up, the outlook could be a little bit more uncertain with respect to are those organizations going to remain intact and able to continue to service the deals that they have and manage them actively and manage them appropriately, or do they start to wander a little bit, or do they get sold to a third party? So I do think the manager tiering is going to be here a little bit to stay. The really strong organizations are the ones that are already seeing their double Bs trade in the low sixes. And they'll be the first ones, obviously, that will go lower than that, and they'll be the ones that will show the recovery the soonest. There may be others that will never quite recover. If we look at just MVOCs for double Bs, which is a big component of how we look at the universe, a few months ago, you had a multitude of deals that were still under 100 MVOC. Now it's more like, I'd say about 78 or so out of the 1,300 that we look at. So it's reasonable. Under 95 is only 16 deals. So if you'd asked me a few months ago, I'd say there's going to be some defaults, and it might be several percent. I think at this point, actually, ironically, if you do the math, that if the 16 that are under 95 right now defaulted, that's only 1.2% of the universe, which is the annualized rate of double B defaults in history. So things are performing as they're expected, but with just increased performance dispersion, you should expect increased dispersion and how the markets look at these deals. So it's here, it's warranted, and it's going to stay here.
Thank you for that. And Shiloh, I just want to go to you real quick. We're a little bit behind, but I want to get in kind of the middle market picture. Middle market triple Bs versus BSL double Bs. What do you think is more liquid or more attractive in your mind?
Sure. So the broadly syndicated are always going to be a lot more liquid because any investor can, pull up Intex and look at the collateral pool and find all the loans marked by market. So it's always going to favor BSL. And in fact, as we discussed on the panel, there's been a ton of liquidity there this year. But the nice thing about middle market double Bs, and we bought a bunch of them this year, especially like right after COVID hit, is that you do get a 13% plus equity subordination underneath you. So like, even though there may be some middle market names in there where the only kind of information you have would either be to call the manager directly or do a Google search and like try to figure something out. I mean, the kind of default rates you'd have to run to break a middle market double B. I mean, it's like COVID plus a war, it's just, and so if you look around and it's really hard to know where the world's going, like a middle market double B is like always a great bet.
Yeah, well, no, that's good insight. So let's switch our focus. I talked about, we're going to discuss forecasts for 2021. I'm going to ask Arun to give us his thoughts on, what your thoughts are going forward. Call it Q1 defaults, volumes, DMs. What are your thoughts?
So can you hear me?
Yes.
Okay. So I would sort of phrase my answer, both in terms of the underlying leverage loan market, because that's going to drive really the impacts, and then what we think is going to be the time lag of the flow back of those defaults or other stress issues into the lower rated tranches in the capital structures of CLOs. So the way we're looking at it is that the first quarter is probably the most challenging in the sense that we have a series of very good pieces of news coming out because we never had so much liquidity before that it was available to companies under stress. So you have a whole range of rescue refinancings, for example, that are in the leverage loan market. Let's put it this way. There was 40% of the leverage loan market was downgraded in 2020, around March. Yeah. But the level of actual defaults is extremely low. And the reason for that is that a lot of these assets got refinanced. And then the impact on the tranches was even lower because there was, again, significant liquidity from a number of sources that were already talked about in the panel. And managers were able to trade out of some of these assets very quickly. And so although the OC tests were breached in some cases, but overall there was nothing industry-wide that we could call a crisis. I think coming back, there are, I would say, 2 or 3 positives and 2 or 3 negatives. So on the positive side, where I don't expect defaults or for that matter, significant tranche level downgrades, is because overall the corporate earnings, quarter by quarter in the leverage loan market are improving, have improved. So already we have data on that. That's number one. Number two, I think the market has understood much better. What is the post-COVID scenario for the leverage loan market in terms of its ability to survive? So, people have adjusted their portfolios for sectors, for names, and so on. And I think that's where also I think if we go into the tiering of managers, I think managers who have been able to understand and react to sectors and names which are opportunities on the one side, because again, I think what we are talking about is stratifying distress. So there's distress that creates opportunity but not default, and there's stress that creates opportunity but with the potential for default. I think so that kind of management, I think, is becoming very critical to essentially taking a view on what kind of assets will face stress as an investor. And so it's not so much as default we're worried about, more what we are worried about is volatility. I think in the first, but we expect that overall is expected that defaults will range from about on an average 8.5% to 9% over the years across the leverage loan market, which will then translate in different ways depending upon where you are in the cap stack, and in different positions. So not a disaster scenario by any means, but something we all need to watch for these various reasons. And again, there are so many new variables that we all talked about. The pace of recovery from COVID, the U.S. policy actions under the new administration, what happens to trade with China and some of the other activities, the level of PE activity, the level of M&A activity in terms of new equity being available and financing the leverage loan market, and essentially keeping the refinancings going, because I think again it's not, these refinancings are not permanent, they will continue to be continued, so there will be more resources available for that. So it's a mix, and I think this is where I think the tiering becomes more important, because unless you are really on top of your game, both in terms of selecting and constructing the portfolio on the one side, and then selecting the right time to enter and exit particular tranches or compositions of those tranches, I think that's going to make more difference, both in terms of managing stress and generating return.
Yeah. Thank you for that. I guess I just want to open it up to anybody else. Steve, we haven't talked to you in a while. Do you have any thoughts in terms of your view on 2021?
Sure. So we talked a little bit about our return expectations earlier on, so I won't belabor that. But in terms of things like issuance, I think most of the projections we've seen out there from research desks are 90 to 100 billion for 2021. I think if I had to take the over under, I'd probably shoot for the over on that. I think we're well positioned for a pretty decent issuance year, driven by tailwinds from demand, I think both for AAAs and equity. I know Shiloh made the comment about the attractiveness of new issue CLO equity. We feel the same way. And I think there's a lot of investors circling out there for new issue equity. So, that coupled with the potential for US banks to come back in bigger size at the AAA level in 2021, and potentially some more overseas banks, I think could drive a good amount of issuance. And then on top of that, I expect refi and reset activity to pick up as well, just given the tightening we've had in liabilities and the recovery we've had in loans. And the desire for managers to try to hold on to AUM if they can. Yeah. In terms of kind of the fundamental background, defaults were at 4% now. We sort of come down a little bit from the peaks. I don't think we'll come down significantly more in 2021. I could see it hovering in kind of that 3.5% to 4.5% range. I think recoveries will continue to be challenged on defaulted loans. And really the reasons for that, I mean, while the macro environment should improve, if you look at just the concentration of defaults in 2020, it was mostly in energy and then very COVID sensitive sectors. And I don't think they're necessarily out of the woods for 2021 at this point. So I think we could continue to see some tail risk there, and that'll play out through the default rate and recovery rate. In terms of spreads, I think, we've all sort of already said it's we've recovered a lot, and so I don't know that there's a lot of room for spreads to run, particularly when you look at where LIBOR is. I don't think we've mentioned that on the call yet, but the difference between now and when we hit 500 on double Bs back in 2018 is that LIBOR is at 23 basis points today. And so the all-in yield potential is a lot different there.
Yeah. No, that's a very good point, especially your point about the refis and resets. You know, some banks are predicting a fairly large avalanche of refis based on, like you said, the tightening that's occurred. So we have about 5 minutes left. I was told I need to leave some time for questions. I'll just ask the moderator if there are any questions to the panelists. We'd love to answer them. And right now, I'm not sure if there are any. I'm trying to see. I don't see any. I guess if I were to say, you know, pick or die in terms of Olivier, in terms of your idea of defaults, are we going over or under the 4% current default?
Yeah, thank you, Anthony. I'm you know, very bad in prediction, generally speaking. But I would not disagree with Steve's comment. You know, I mean, first of all, you know, we've reached a peak in September at 4.2%, and now, you know, I like the decreasing trend. I hope this can continue. I'm always, you know, this is a kind of, you know, trading discipline, but I'm more looking at the worst case scenario than the base case.
Sure.
So, you know, when I look at the half empty glass, what I tend to say to myself is that we should not exceed the sort of break-even level that Shiloh was describing before at double B level. You know, you are above 5-6%. This is annual default rate. So even if we peak, if default are higher than expected, let's say my sort of expectation is, you know, as Steve said, around 4% for 2020. But even if it increase at the double B level, and if you know, the I would say CLO Mezz exposure is well selected, you can get to a much higher break even, and this is annual break even. So you'll have to see, you know, 6.5% default
Sure.
every year. So that's that's, you know, also a reason why we are comfortable. And, you know, I agree with what was shared in the panel before in terms of you know, the why CLO mezzanine are attractive. Another slight point that I just want to comment on what was said before by you know, Andy and Steve about reset and refi.
Yeah.
I mean, I suppose a lot of you know, CLO mezzanine player appreciate the convexity. This, I would say, duration arbitrage or convexity has not really worked out, because we tend to forget it. But in 2019 we had a little bit of volatility. You know, loan price moved from 94 to 97, so it looked like nothing compared to what we've seen this year. But you know, I've seen a lot of deals that were very close to get you know, called or reset in 2019, and they were pushed to 2020. And now we've seen in 2020 with the COVID-19, it's pushed again. So we are coming to a stage where CLO are becoming a little bit more exposed to mark-to-market. And without throwing any prediction, I mean, I personally hope that price will be supportive and the proper restructuring will be able to occur. But this might change a little bit the profile maybe of the typical buyer, by seeing that, you know, exiting a CLO is not as easy as people might seem, you know, because if you cannot reset, if you cannot, I mean, there will be refi for sure, but if you cannot reset, some people might stay much longer than expected in CLO. And I'm not entirely sure, you know, most of the player has the right structure or vehicle to hold CLO for that longer than expected.
I think Olivier is absolutely right. That's the biggest uncertainty, I think, for next year. Steve's spot on. Every single sell side has said so far 90 to 100 billion of new issue. but their predictions for reset volume have been varied from 45 to 150.
Right.
So I think that's what we're really going to be. That's going to be a big factor for next year. And I agree with Olivier. It's not as easy to reset. We've only seen 3 or 4 since in the last few months, and that's since COVID. So it's taken a little bit of a while for that engine to start moving, and it'll be interesting to see if it really does pick up next year.
Yeah. Well, guys, we've actually come to the end of our time. Thank you so much. I really appreciate the contributions that you've made and the excellent panel, guys. And hopefully, if there's any questions, feel free to reach out to me. We're happy to answer anything. And you guys have a great rest of the year and good luck.
Thank you.
Thank you.
Thanks,
Merry
Andrew.
Christmas, happy holidays, happy New
Yes.
Year. Stay safe, healthy.
Yes, everybody, please.
Thank you.
Thank you.
All right.
Bye-bye.
Well, thank you again, Anthony, Shiloh, Steve, Andy, Oliver, Arun, for that conversation. I wanted to echo what Anthony just said. If you have any questions for the panelists, definitely feel free to reach out to them directly. We have a chat function where you can message them directly. So that would be a great way. If there was a question that wasn't able to get answered, that you could just speak with them about that. Now we're going to take our next networking break and exhibitor showcase. Be sure to talk to your fellow event attendees, visit the exhibitor booths to connect with some of our sponsors. Again, win some great prizes. We'll see you back here at 3:20 for our next panel, S&P Corporate Analyst panel. What's the road back for the most affected sectors?